Listen up, because what I'm going to lay out for you isn't some wild conspiracy or clickbait headline designed to shock you into watching. This is about something happening to your money right this second, a process so gradual that most people won't notice until it's far too late to do anything about it. Your purchasing power is evaporating while you sleep, and the truly unsettling part is that this isn't some accident or policy failure. The system is operating exactly as intended, and you're on the losing end of that equation unless you understand what's really going on. Take a hard look at what the Bureau of Labor Statistics tells us. Since the beginning of 2020, the dollar has shed nearly a quarter of its buying power. That's government data, straight from the source, no adjustments or interpretations. But even that alarming figure doesn't capture the full picture of what's actually happening to your wealth. The way inflation gets measured has been quietly tweaked and modified over decades, systematically excluding or downplaying the very expenses that hit your wallet hardest. The rent or mortgage payment consuming a massive chunk of your paycheck, the grocery bill that seems to climb every month, the energy costs that never seem to go down, the medical expenses that can bankrupt families. These items either get minimized in the official calculations or measured in ways that don't reflect reality. If we measured inflation using the same methods economists used back in 1980, before all these convenient adjustments were introduced, the real loss of purchasing power over the last 5 years approaches 40%. Think about what that means in concrete terms. Imagine you had $100,000 sitting in your savings account at the start of 2020, earning whatever minimal interest your bank was offering. The actual buying power of that money today is closer to $60,000. You didn't gamble it away in the stock market. You didn't blow it on bad business deals. You simply held dollars, which most people consider the safest thing you can do with money, and you lost 40% of your wealth to a process most people don't even realize is happening. What makes this truly critical to understand right now is that we're not looking at some gradual, stable decline. We're entering an acceleration phase. Over the next year and a half, the factors driving dollar devaluation are converging in ways that will intensify the destruction of your purchasing power. The federal government is spending money it doesn't have at unprecedented levels. The Federal Reserve finds itself stuck between allowing inflation to run wild or watching the banking system collapse, and countries around the world are actively working to reduce their dependence on the dollar, which decreases demand for our currency. When demand drops while supply increases, the value has to fall. That's not economics, that's just basic math. What I'm going to show you is exactly how this currency devaluation mechanism operates, why it's mathematically guaranteed to continue given our current debt situation, and most importantly, the specific moves you need to make to avoid getting crushed by this wealth transfer. By the time we're done here, you'll have a clear framework that separates people who preserve their wealth from those who watch it disappear. This isn't about predicting some future collapse. This is about recognizing that the collapse is already underway in slow motion and positioning yourself accordingly. There's a concept in monetary economics called the impossible trinity, and understanding it frames everything else we're going to discuss. The principle states that any country's monetary system can only achieve 2 out of 3 objectives simultaneously: maintain a fixed exchange rate, allow free movement of capital, and conduct independent monetary policy. You're forced to pick 2 and sacrifice the third. When the United States ended dollar convertibility to gold in 1971, we abandoned fixed exchange rates, which gave our central bank complete freedom to manipulate monetary policy however it wanted. But here's the catch that most people miss. That freedom only exists as long as the rest of the world keeps accepting dollars and holding them in reserve. The moment that global confidence cracks, the whole framework falls apart, and the Federal Reserve loses the control it thinks it has. We're watching that loss of control play out right now, just slowly enough that most people don't perceive the danger. The framework I want you to internalize is built on a straightforward observation. When the currency itself is being deliberately debased, holding cash isn't a neutral, safe position. It's an active bet that you're making whether you realize it or not. You're betting that the central bank will maintain stable prices, that politicians will suddenly develop fiscal discipline after decades of deficit spending, and that countries worldwide will continue demanding dollars at current levels. Every single one of those assumptions is demonstrably wrong, and the evidence is sitting right in front of us if we're willing to look at it honestly. Here's my core argument, stripped down to its essentials. The dollar is experiencing a structural devaluation driven by 3 interconnected forces: the government's need to finance massive deficits, the Federal Reserve's willingness to create money to buy government debt, and the gradual erosion of the dollar's status as the world's reserve currency. The investors who recognize these dynamics early and move their wealth into assets that can't be printed are going to preserve and grow their purchasing power. Those who wait for mainstream confirmation, who want to see the crisis validated by CNBC or their financial advisor before taking action, will watch their wealth evaporate in real terms even though their bank account balances might not change much in nominal dollar terms. This isn't about trying to time some dramatic market crash or economic catastrophe. It's about understanding that the catastrophe is already happening, just distributed over years rather than compressed into weeks, and making the necessary adjustments to your financial positioning to really grasp why the current situation represents a fundamental break rather than just another economic cycle. We need to look at historical parallels. The first example that's instructive is the currency collapse in Weimar Germany during the early 1920s. Most people know the images. Citizens pushing wheelbarrows full of cash just to buy basic necessities, children playing with stacks of worthless bills, the total destruction of the German middle class through hyperinflation. But what's crucial to understand is how it began, because the starting conditions look disturbingly familiar. It didn't kick off with some sudden panic or overnight loss of confidence. The German government had massive debts from World War I and domestic spending obligations it couldn't meet through taxation. So the Reichsbank, their central bank, started printing money to purchase government bonds, which injected new currency into the economy without any corresponding increase in actual productive output. For the first couple of years, from 1919 through 1921, the inflation was present but manageable. Prices were rising certainly, but not at catastrophic levels. The middle class, the civil servants collecting government paychecks, the retirees living on pensions, they kept their savings in bank accounts denominated in marks because they trusted the system. They believed the authorities would get things under control. They had faith that the currency would stabilize. By 1923, the mark had been completely annihilated. The exchange rate went from around 4 marks per dollar in 1914 to over 4 trillion marks per dollar by November 1923. The people who preserved any wealth at all were those who converted their marks into tangible assets early in the process: real estate, gold, foreign currency holdings, ownership stakes in productive businesses. The people who waited, who trusted official reassurances, who believed things couldn't possibly get that bad, lost absolutely everything they had saved over their entire lives. The lesson from Weimar isn't that America will necessarily experience that same level of hyperinflation starting tomorrow morning. The lesson is that currency devaluation happens in stages. It begins slowly and manageably. Then it accelerates. And by the time the general public recognizes the threat for what it is, the window for protecting your wealth has already closed. The asymmetric opportunity exists in the early stages, when the process is still gradual enough that most people remain complacent. The second historical example that's even more relevant to our current situation is the dollar devaluation that occurred during the 1970s. The macro setup then mirrors what we're experiencing now in almost eerie detail. In the late 1960s, the United States government was running enormous fiscal deficits to fund both the Vietnam War and President Johnson's Great Society domestic spending programs. The Federal Reserve was accommodating those deficits by keeping interest rates artificially suppressed, which created inflationary pressure throughout the economy. Foreign governments, particularly France under President Charles de Gaulle, recognized that dollars were being debased and started demanding gold in exchange for their dollar reserves, as was their right under the Bretton Woods Agreement. By 1971, the United States faced a run on its gold reserves that threatened to drain Fort Knox entirely. President Nixon had no choice but to close the gold window, ending the convertibility of dollars into gold and effectively breaking America's promise to foreign creditors. What followed was a decade of monetary chaos that destroyed the wealth of anyone who stayed in traditional assets. The dollar lost more than half its purchasing power between 1971 and 1980. Inflation peaked above 14% in 1980. Real interest rates, meaning the interest rate minus the inflation rate, were deeply negative throughout most of the decade. Anyone holding cash or bonds was losing purchasing power every single year, guaranteed. Here's what's critical to understand about that period. The stock market went essentially nowhere in nominal terms and got absolutely crushed in real terms. The Dow Jones Industrial Average sat around 800 in 1970 and was still around 800 in 1980, a decade of going nowhere. But when you adjust for the inflation that occurred during those years, investors in a traditional stock portfolio lost over 60% of their real purchasing power. Holding stocks didn't save you. Holding bonds certainly didn't save you. The only assets that preserved and multiplied wealth during that decade were hard assets that couldn't be created by central banks pressing buttons. Gold went from $35 per ounce in 1971 to $850 per ounce in 1980, a 24-fold return that not only preserved purchasing power, but multiplied it dramatically. Silver went from $1.50 to $50, a 33-fold return. Energy stocks, commodity producers, ownership of real assets like agricultural land and timber, these massively outperformed traditional financial assets. The investors who understood that the 1970s represented a structural currency devaluation rather than a temporary inflation spike positioned themselves accordingly and came out the other side wealthier than they started. Those who stayed in the conventional 60-40 portfolio, allocation of stocks and bonds that financial advisors recommend, watched their wealth evaporate in real terms. Now let's connect these historical lessons to what's happening right this moment, because the parallels aren't just similar, they're nearly identical in structure. The United States federal debt currently sits at $36.2 trillion, which represents 122% of GDP. That's the highest debt to GDP ratio we've ever had outside of World War II, when we were fighting for national survival against fascist regimes that threatened to conquer the world. But here's the mechanism that really matters for your personal wealth. The annual interest expense on that debt has now exceeded $1.1 trillion. That's more than we spend on the entire Defense Department. That's more than Medicare. And it's growing exponentially because as old debt matures, it has to be refinanced at today's higher interest rates rather than the rock-bottom rates of the past decade. The Congressional Budget Office, which produces long-term fiscal projections, estimates that by 2034, interest payments will exceed $1.6 trillion annually and consume more than 20% of all federal tax revenue. Just think about that for a moment. 1 out of every $5 the government collects in taxes will go purely to interest payments on past borrowing, producing absolutely nothing of value for current citizens. This creates what economists call fiscal dominance, which is a fancy way of saying the government can no longer afford to let interest rates rise to whatever level would be necessary to control inflation, because doing so would make the debt burden unsustainable and force either outright default or massive spending cuts that would be political suicide for whoever implemented them. So the Federal Reserve finds itself trapped. They can't raise rates high enough to truly crush inflation without triggering a sovereign debt crisis that could bring down the entire financial system. And they can't lower rates back to zero without destroying whatever credibility the currency still has and reigniting inflation expectations that would become self-fulfilling. The only way out of this trap is something called financial repression, which is a policy framework where real interest rates are kept deliberately negative in order to inflate away the debt burden over time. This represents a massive wealth transfer from savers to borrowers, from creditors to debtors, from private citizens to the government. And it's not some theoretical future policy. It's happening right now. Let me show you the mechanics of how this works in practice, because most people don't understand what negative real interest rates actually mean for their savings. The Federal Reserve's policy rate currently sits at 4.5%. The official Consumer Price Index inflation rate is running at 2.9%. If you subtract inflation from the interest rate, you get a real interest rate of 1.6%, which sounds positive and reasonable. But here's the massive problem with that calculation. The CPI dramatically understates real inflation because of methodology changes that have been implemented over the past 4 decades, each one conveniently making inflation appear lower than it actually is. Shelter costs, which represent 35% of the CPI basket and are typically the largest expense for American households, get calculated using something called owner's equivalent rent. This methodology looks at what homeowners could theoretically rent their homes for, rather than what they actually pay in mortgage payments or what homes actually sell for. This introduces a lag of 18 to 24 months, meaning the CPI shelter component is always reflecting housing costs from nearly 2 years ago, rather than what's happening right now. Food and energy, the most volatile components that people experience every time they go to the grocery store or gas station, are often stripped out entirely when calculating core inflation, as if people can just stop eating and driving when those prices rise. The CPI also uses something called hedonic adjustments and substitution effects. Hedonic adjustments assume that if a computer is twice as powerful as last year's model but costs the same price, that represents a price decline, even though you're paying the same amount of money. Substitution effects assume that if steak gets too expensive, consumers will simply buy chicken instead, so the inflation rate doesn't need to reflect the steak price increase. These methodologies were explicitly designed to make inflation appear lower than what people actually experience in their daily lives. When you strip out these convenient adjustments and measure inflation using the methodology that was actually applied in 1980, before all these changes were introduced, the real inflation rate comes out somewhere between 8% and 10%. That means real interest rates aren't positive 1.6%. They're negative 3.5% to 5.5%. And in that environment, holding cash in a savings account is a guaranteed wealth destroyer. You're losing purchasing power every single year, and the compounding effect is absolutely devastating. At a 5% negative real interest rate, your cash loses half its purchasing power every 14 years. If you're 40 years old today and you're holding significant cash savings, by the time you reach 68 and want to retire, that cash will be worth less than 25% of what it represents today in terms of actual goods and services you can purchase. This isn't market risk that you might avoid by being smart or lucky. This is a mathematical certainty built into the policy framework that governs our monetary system. Now let's layer on the second mechanism that's accelerating dollar devaluation, which is the global shift away from dollar-denominated trade and reserve holdings. For the past 80 years, since the Bretton Woods Agreement was established after World War II, the US dollar has functioned as the world's reserve currency. Foreign governments and central banks hold dollars as a store of value and use dollars to settle international trade transactions. This creates what's called exorbitant privilege. The United States can print dollars and export them in exchange for real goods and services because the rest of the world needs dollars to function in the global economy. But that system is breaking down, and the cracks are becoming impossible to ignore. China and Russia have been conducting bilateral trade in yuan and rubles since 2014, completely bypassing the dollar for transactions between the world's largest energy exporter and the world's largest manufacturing economy. The BRICS nations, which include Brazil, Russia, India, China, South Africa, along with newly added members Saudi Arabia, United Arab Emirates, and Iran, are actively building alternative payment systems that don't route through dollar-based infrastructure and are discussing the creation of a new currency backed by a basket of commodities, including gold. Saudi Arabia, which has priced oil exclusively in dollars since the petrodollar agreement of 1974 that essentially forced any country wanting to buy oil to first acquire dollars, has now begun accepting yuan for oil sales to China. This isn't symbolic politics or posturing. This is structural change in how the most important commodity in the world gets priced. When oil, the single most traded commodity on the planet, is no longer exclusively priced in dollars, global demand for dollars necessarily declines. And when demand declines while the Federal Reserve continues increasing supply through money creation, basic economics tells us the value must fall. We can see this shift happening in the actual data if we know where to look. Central bank gold purchases hit an all-time record in 2022 and have remained elevated through 2025, with countries like China, Russia, Poland, Singapore, and various Middle Eastern sovereign wealth funds accumulating over 100 tons of gold annually. These aren't inflation hedges or portfolio diversification moves. These are strategic reserve reallocations away from dollar-denominated assets. When central banks worldwide are net sellers of dollars and net buyers of gold, that represents a vote of no confidence in the currency, and it accelerates the devaluation process because it reduces global demand for dollars at precisely the moment when supply is increasing. The third force driving dollar devaluation is the Federal Reserve's balance sheet, which remains massively bloated despite the supposed quantitative tightening program they've been running. The Fed's balance sheet peaked at $9 trillion in 2022 after all the COVID stimulus programs pumped money into the system. It has since declined to around $7.2 trillion, which sounds like progress until you realize that's still nearly double the pre-2020 level of $4 trillion. That excess, $3.2 trillion, represents dollars that were created out of thin air, conjured into existence by Federal Reserve computers, and injected into the financial system. Those dollars didn't disappear when the Fed stopped expanding the balance sheet. They're still circulating in the economy, chasing a relatively fixed supply of goods and services, which is the absolute textbook definition of inflation. Here's the mechanism that locks in further devaluation going forward. The federal government is currently running deficits between $1.7 trillion and $2 trillion annually, which means the Treasury Department has to issue that much new debt every single year just to cover the gap between tax revenue and spending. If the private market were required to absorb all of that debt issuance, interest rates would have to rise dramatically to attract enough buyers. Higher rates would mean higher borrowing costs for the government, which triggers the fiscal dominance crisis we discussed earlier. The debt becomes unsustainable. So the Federal Reserve steps in, either directly or indirectly through financial intermediaries and primary dealers, and purchases a portion of that debt. This is debt monetization, which is just a technical term for printing money to fund government spending. and every new dollar that gets printed dilutes the value of every existing dollar in circulation, including the ones sitting in your bank account. This isn't conspiracy theory territory. This is documented in the Federal Reserve's own H41 statistical release, which shows the detailed composition of the Fed's balance sheet every week. The mechanism is operating in plain sight. The only question is whether you understand the implications for your personal wealth. So what are the specific moves that allow you to not only protect your wealth, but actually position yourself to benefit from this dollar devaluation? There are 3 asymmetric plays that I want you to understand completely. The first move is accumulating physical precious metals, specifically gold and silver, held outside the banking system. This isn't a trade where you're trying to time entries and exits. This isn't speculation on whether prices will go up next month. This is monetary insurance, a way to preserve purchasing power across currency regimes. Gold has served as money for 5,000 years across every major civilization that has ever existed because it possesses properties that make it ideal for storing value. It's scarce in nature, with all the gold ever mined in human history fitting into a cube about 70 feet on each side. It's virtually indestructible, lasting essentially forever without degrading. And most importantly, it cannot be created by a central bank pressing buttons on a computer. When currencies get debased through excessive printing, gold maintains purchasing power across that debasement. In 1971, an ounce of gold could buy you a high-quality men's suit. Today, an ounce of gold still buys you that same quality suit. The dollar price of gold has risen from $35 to over $2,600. But that's not because gold became more valuable in absolute terms. It's because the dollar became less valuable. Gold's purchasing power remained constant while the currency depreciated around it. Silver has these same monetary properties as gold, with the additional catalyst of significant industrial demand from solar panels, electric vehicles, electronics manufacturing, and medical applications. This dual demand profile creates interesting dynamics. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, currently sits around 88.1. The historical average over the past century is closer to 60.1, and during periods of monetary stress, that ratio has compressed down to 30.1 or even lower. That means silver is significantly undervalued relative to gold at current prices and has substantial catch-up potential if we see monetary stress intensify. The action step here is to allocate a minimum of 15% to 25% of your liquid net worth into physical gold and silver, not exchange-traded funds, not mining stocks, not paper claims on metal that exist as entries in a database somewhere, physical bars and coins that you either hold in your personal possession or store in a fully allocated, segregated vault outside the banking system. This removes counterparty risk, which means you're not dependent on some institution honoring their promise to deliver metal to you at some future date. When currency devalues, your purchasing power is preserved because you own the actual physical asset. The second asymmetric move is gaining exposure to precious metals mining companies, specifically the senior producers with high-quality assets in politically stable jurisdictions. When gold and silver prices rise, mining companies benefit from what's called operational leverage. Their costs to extract metal from the ground are relatively fixed in the short term, while their revenue increases directly with the metal price. Think about a mining company with all-in sustaining costs of $1,400 per ounce. At a gold price of $1,600, they're generating about $1,200 per ounce in free cash flow. If gold moves to $4,000 per ounce, which is entirely plausible in a currency devaluation scenario, that same company is now generating $2,600 per ounce in free cash flow. Their profitability more than doubles. The stock market values these companies based on multiples of their cash flow and earnings. So a 50% increase in the gold price can easily translate into a 100% to 200% increase in the stock price because the cash flow increase is so dramatic. This gives you leverage to the metal price without using margin or taking on debt that could be called away from you at the worst possible time. The companies you want to focus on are those operating in Canada, Australia, the United States, or other jurisdictions with stable governments and rule of law. You want strong balance sheets with minimal debt and proven management teams with a track record of intelligent capital allocation rather than empire building. Names like Newmont, Barrick Gold, Agnico Eagle, and Franco-Nevada, which is actually a royalty company that doesn't operate mines but receives a percentage of production from mines operated by others, represent the highest quality exposure you can get. Silver miners like First Majestic Silver, Endeavour Silver, and Mag Silver offer even greater leverage to metal prices. though with correspondingly higher volatility and risk. The appropriate allocation here is 10% to 15% of your portfolio if you understand the thesis and can tolerate the equity market volatility that comes with these positions. The third asymmetric move is acquiring hard assets that have intrinsic value and generate cash flows. This category includes productive agricultural land, energy infrastructure, water rights, timber acreage, and businesses directly linked to commodity production. These assets possess several characteristics that make them ideal for a currency devaluation environment. First, they produce real goods that people need regardless of what's happening with the monetary system. Food doesn't lose demand when currencies devalue. Energy consumption doesn't drop to zero. Water remains essential to human life. These are non-discretionary necessities. Second, they have inherent pricing power. When inflation accelerates and paper currencies lose value, commodity prices rise in nominal terms, which means the cash flows these assets generate increase accordingly. Third, they're tangible and exist outside the financial system. Unlike a stock certificate or a bond, which is merely a claim on future cash flows denominated in a depreciating currency, a productive asset generates value in real terms that maintains purchasing power. The challenge with this category is that these assets require significant capital to acquire and often need active management or specialized knowledge. You can't buy farmland through your brokerage account with a few mouse clicks. You need to understand agriculture, soil quality, water access rights, commodity market dynamics. But for investors who have the resources and expertise, or who are willing to acquire that expertise, this is where generational wealth gets built and preserved across currency regimes. The ultra-wealthy have been quietly accumulating these assets for the past decade, while retail investors chase technology stocks. Bill Gates is now the largest private farmland owner in the United States, with holdings exceeding 250,000 acres. Sovereign wealth funds from China, Singapore, and Middle Eastern countries have been systematically buying agricultural land, timber, and water rights across North America and Australia. These sophisticated investors understand that in a currency devaluation environment, the real assets appreciate in nominal price terms while maintaining their intrinsic value, while the currency depreciates against those assets. Now let's talk about the specific signals that indicate this dollar devaluation is accelerating right now, and why the next 18 months represent such a critical window for positioning. The first signal to watch is the velocity of money, which measures how quickly dollars circulate through the economy. After collapsing during COVID lockdowns when economic activity ground to a halt, M2 velocity has stabilized but remains well below pre-2020 levels. This matters enormously because if velocity begins to rise as economic activity fully normalizes and people start spending the massive amounts of cash sitting in the system, that $3 trillion in excess money supply will start chasing goods and services. That acceleration will force the Federal Reserve to make a choice between fighting inflation with much higher interest rates or accepting ongoing currency debasement. Every indication suggests they'll choose debasement because the alternative triggers the fiscal crisis. The second signal is the Treasury yield curve, specifically the spread between 2-year and 10-year government bond yields. After being inverted for over 18 months, where short-term rates were higher than long-term rates, the curve has steepened significantly. This historically signals that bond investors expect inflation to rise over the medium term. When long-term rates rise faster than short-term rates, the market is pricing in either higher inflation or demanding a higher term premium to compensate for holding depreciating currency over longer time periods. Both of those outcomes are terrible for anyone holding cash. The third signal is the dollar index, which measures the dollar's value against a basket of foreign currencies, including the euro, yen, and British pound. The DXY has been trading in a range between 100 and 106 for the past couple years, which on the surface looks like stability. But that stability is completely deceptive because it only measures the dollar against other fiat currencies that are also being debased. The euro is being printed, the yen is being printed at an even faster rate than the dollar, the pound is being printed. When you measure the dollar against hard assets like gold, commodities, or real estate prices, the currency has been in a structural downtrend since 2020. The dollar index gives you false comfort that things are stable when measured against the things that actually matter. Purchasing power is declining steadily. The fourth signal is the fiscal trajectory itself, which is locked in by political constraints that make it essentially irreversible. The Congressional Budget Office projects that federal deficits will average $2 trillion annually for the next decade, even under optimistic assumptions about economic growth and tax revenue. That's $20 trillion new debt over 10 years, added on top of the existing $36 trillion. There is no mathematically possible path to fiscal sustainability without either massive tax increases that would be political suicide for whoever implemented them, or debt monetization through Federal Reserve money printing, which is currency devaluation, the math here is completely non-negotiable. The numbers don't work any other way. So what do you actually need to do right now? Let me give you a concrete action checklist. And I need you to take this seriously because the window for optimal positioning is narrowing with each passing month. First, you need to honestly assess your current cash holdings and recognize that cash is not a safe asset in this environment. If you have more than 6 months of living expenses sitting in a checking or savings account earning 3% or 4% interest, you're taking on uncompensated inflation risk. The return you're getting doesn't come close to compensating for the purchasing power loss you're experiencing. The action is to reduce your cash allocation down to only what you need for immediate liquidity and emergency reserves, and rotate the excess into hard assets that preserve purchasing power. Second, you need to establish a core position in physical gold and silver. If you've never purchased precious metals before, start with a reputable online dealer like APMEX, SD Bullion, or JM Bullion. Buy standard bullion products like American Gold Eagles, Canadian Maple Leafs, or 1-ounce silver rounds. Avoid numismatic coins or collectibles with high premiums over the spot metal price. Take physical delivery and store the metal either in a safe at your home or use a fully allocated storage service like Brinks or a private vault facility. Do not use bank safe deposit boxes because during a crisis, banks can restrict access to those boxes and you won't be able to get to your metal when you need it most. Third, you need to gain diversified exposure to precious metals mining companies through a standard brokerage account. If you don't have the time or expertise to research and pick individual mining stocks, use a high-quality exchange-traded fund like GDX for large-cap gold miners or GDXJ for junior mining companies. Understand going in that these positions will be volatile, potentially moving 20% or more in relatively short time periods. You need the conviction and emotional discipline to hold through those drawdowns rather than panic selling at the bottom. Fourth, if you have significant wealth, meaning high 6 figures or more in investable assets, you need to start thinking seriously about real asset diversification beyond just metals. This might mean purchasing agricultural land through a managed farmland fund, investing in energy royalties through master limited partnerships, or buying timber through a real estate investment trust. The key principle is owning assets that produce value in the real physical economy, not just financial returns denominated in depreciating currency. Fifth, you need to significantly reduce or eliminate your exposure to long-duration fixed income securities. Bonds are essentially promises to pay you back in currency at some future date. In a financial repression environment where currency is being deliberately devalued, bonds are wealth destroyers. Move into shorter duration Treasury inflation-protected securities if you need fixed income exposure, or eliminate bonds entirely in favor of the hard assets we've discussed. Here's the question I want you to think about carefully. What percentage of your total portfolio is currently allocated to protection against dollar devaluation? Are you holding physical gold and silver? Do you have exposure to mining stocks? Have you acquired any real assets outside the financial system? Or is your wealth still concentrated in cash and traditional equities that assume currency stability? Your honest answer to that question tells you how exposed you are to what's coming. If you found this breakdown valuable, if you now understand why dollar devaluation isn't some future risk, but a present reality that's happening in real time, I need you to do something for me. Share this information with anyone you know who's holding significant cash savings or who believes a bank savings account is a safe place for long-term wealth preservation. They need to understand that the rules have fundamentally changed, that cash is no longer safe, and that the opportunity to protect wealth through proper positioning is available right now, but won't remain open indefinitely. The dollar devaluation is happening now. The mechanisms are in place. The policy trajectory is locked in by mathematical constraints and political realities. The only remaining question is whether you recognize it early enough to position yourself on the right side of the largest wealth transfer in modern history. The decisions you make over the next 90 days will determine whether you're a wealth preserver or a wealth loser in what's coming. Make them count.